Welcome. Today, we're discussing a foundational text in the world of finance, Benjamin Graham's The Intelligent Investor. First published in 1949, this book remains remarkably relevant for anyone serious about building wealth through investing. Graham, often called the father of value investing, provides a framework centered on logic and discipline, not speculation or market timing. His principles are designed to protect investors from significant error and guide them towards sustainable, long-term success. A core distinction Graham makes is between investing and speculating. An investment operation, he states, is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. True investing focuses on the underlying business value. Speculation, conversely, often chases price movements or relies on predicting short-term market swings. Graham strongly advises against speculation for the average person. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. One of Graham's most famous analogies is Mr. Market. Imagine you own a share in a business alongside a partner named Mr. Market. Every day, Mr. Market offers to buy your share or sell you his. Sometimes Mr. Market is cheerful and offers a very high price. Other times he is depressed and offers a very low price. His moods are often irrational and driven by emotion, not the business's true value. The intelligent investor does not let Mr. Market's moods dictate their decisions. They use his offers only when they are advantageous, buying when he is depressed and selling when he is overly optimistic. They focus on the intrinsic value of their holdings. Perhaps the most critical concept in the book is the margin of safety. This means buying an asset for significantly less than its intrinsic value. It's like building a bridge strong enough to hold far more weight than it will ever carry. This buffer protects investors from errors in judgment or unforeseen economic downturns. It acknowledges that analysis is imperfect and the future is uncertain. The margin of safety is the bedrock of value investing. It provides room for error and reduces the risk of permanent capital loss. Graham insists that without a sufficient margin of safety, an investment is speculative, regardless of its perceived quality. Graham distinguishes between two types of investors: the defensive and the enterprising. The defensive investor seeks safety and freedom from effort. They build a simple, diversified portfolio of high-quality, stable companies and bonds. They are content with average returns and avoid complex strategies. Their focus is on preservation of capital and consistent income. This approach suits those with limited time or expertise for detailed analysis. The enterprising investor, on the other hand, is willing to devote more time and effort to finding undervalued opportunities. They may look at less popular companies or employ more complex analysis techniques. This approach requires more skill, diligence, and a deeper understanding of security analysis. Graham warns that few investors have the temperament and ability to be truly successful enterprising investors. Graham provides guidance on portfolio allocation, typically suggesting a balance between stocks and bonds. A common recommendation is a 50-50th split, adjustable based on market conditions and the investor's risk tolerance. During periods of market overvaluation, the bond allocation might increase. When stocks are undervalued, the stock allocation could rise. However, Graham advises against extreme shifts based on short-term predictions. The key is diversification across different industries and asset classes. This reduces the impact of poor performance in any single holding. While Graham wrote extensively on detailed security analysis, the intelligent investor provides principles accessible to the average person. The focus is on understanding the business, its financial health, and its earnings power. Investors should look for companies with a history of profitability and strong financial standing. They should be wary of excessive debt or inconsistent earnings. The goal is to buy a piece of a sound business at a reasonable price. Graham emphasizes looking at financial statements and historical performance, not just future projections or market sentiment. He encourages investors to think like owners of the business. Beyond analysis, Graham stresses the importance of temperament. The intelligent investor must be patient, disciplined, and emotionally detached from market fluctuations. They must resist the urge to panic sell during downturns or chase hot stocks during bubbles. Emotional control is paramount to long-term success. The market is there to serve you, not instruct you. In a world increasingly dominated by algorithmic trading and short-term thinking, Graham's principles remain a vital counterpoint. His focus on value, safety, and long-term perspective is timeless. The intelligent investor is not a get-rich-quick manual. It is a guide to building wealth steadily and safely over time through rational, disciplined investing. It is essential reading for anyone seeking a sound financial future. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Subscribe for more summaries.